Good morning, everyone, and thank you so much for joining this session on a Saturday morning. I truly appreciate the enthusiasm with which you've participated in this PL Academy session. And again, I would like to thank you. Pairs is a very, very old kind of technique, but in India, it's been used very rarely. Some of the broking houses started it and ended it and all that. But the truth of the matter is that pairs are actually, if done very well, one of the safest ways to participate in capital markets, especially in volatile instruments. And if you become a pair trader, the way you see markets and the way you see, individual instruments actually can change dramatically. Now, during this presentation, the agenda is to introduce you to what basically pairs trading means in simple terms, as simple as we can do it. What are the parameters used in choosing very safe pair trades, and how you can go about executing these trades, and any other resources that you can utilize. And at the end of the session, Shilpa will create a group on WhatsApp with all the participants here added, all the paid participants added to that group so that we can stay in touch. And over the next 1 or 2 months, you can start sort of experimenting with these. Now, remember that while I'm not going to talk about it, if you have any technical tools, etc., then they could help you further, refine your pair trades. However, let's start very, very simply. Um, Essentially, over a period of years, we've realized that capital markets can be extremely volatile, and taking any positional view on stocks or markets can be very, very dangerous, right? We've all lost money in markets, we've all mistimed trades, and so on and so forth. So what if there was a class of trades which could allow you to profit with almost 95 to 98% certainty? I mean, obviously, I'm rattling these numbers off because I believe that once you've started pairs trading and experienced some bits of ups and downs, you'll be able to refine your strategy further. And I've seen that, if you do these trades well, the probability of at least not losing money is almost 100%. And it depends on experience as well as the skill with which you carry out your analysis. Uh, One more thing, which is very visible to a pair trader, but which is not possibly visible to the naked eye, is that markets actually often tell you what they intend to do. However, in the daily ups and downs and the volatility and the news and so on and so forth, we often forget that people in the markets are building positions in certain instruments. And if we saw them differently, there is a very nice way in which the markets are telling us a story on what could happen over the next 1 week, 3 months, 6 months, 1 year. And we have to listen to these carefully. We don't have to be afraid, neither should we be confused. Um, Momentum is a lie, meaning that today you're up 5% and tomorrow you're down 5% is not an everlasting phenomenon, right? Markets go through their ups and downs. However, once you become a pair trader, and you'll see it in the next few slides, you'll realize that if you start looking at relative momentum, by relative momentum, I mean, for example, don't look at momentum of Reliance, but look at, for example, momentum of Reliance versus the energy sector or Reliance versus the Nifty. And you will see that the relative momentum charts are much more smoother and therefore easier to trade on. The fourth rule in markets is, and this is true about certain sectors, I mean, we've been seeing, right, over the last 1 week itself, metals went up, all of them went up very sharply, right? Some X% and some Y%, but in the same direction and very sharp moves. Similarly, over the last 2 days, we've seen this for the cement sector. So, and when Bank Nifty started moving up from 29,000 to 36,000, almost all the banks went up. You had IndusInd also moving, and Axis also moving, and ICICI also moving. PSU is also moving, and private sector also moving, right? So all sectoral stocks, as long as they are very, very similar in nature, will tend to participate in droves, in groups, en masse, when a particular index starts to display momentum. This phenomenon is typically called what, in mathematics is called correlation. But broadly, I'm sure we are all intuitively aware that all the elements of one sector start moving together when the sector itself starts moving in one direction. The fifth and final learning that at least I have done is that derivatives are actually very, very safe. Ironically, derivatives are dangerous instruments, but if deployed very well, I believe And when I'm saying derivatives, I especially mean futures. I mean, you can execute some strategies through options also, but I don't see options as a way of trading continuously profitably unless you're scalping money, in which case it's a different thing, or you have a very refined strategy. Uh, if futures are deployed properly with proper analysis, I think actually derivatives are safer than even holding stocks in some cases. Now, with these 5 learnings is how I started personally, deploying pair trades and experimenting with pair trades. And if some of you are customers, you would know that we've given a lot of trades over the last 1 year, and I don't think we've had more than 1 or 2 losses. Meaning that our loss ratio is about 5% over the last 1 year. Now, imagine if you could tame the markets, not be scared of them. If you could have strategies which look only at relative momentum, through safely crafted derivative strategies, what could be better? This is exactly what pairs trading is about. Now, what are pair trades? Pair trades essentially started off in I think, 1984, and Morgan Stanley was the first international bank that deployed this. And over the next 20, 25, 30 years, there were 2 great institutions. One was Morgan Stanley and one was LTCM. LTCM collapsed in 2007, but Morgan Stanley actually managed Harvard's benefit fund, the scholarship benefit fund, for almost 30 years using only pair trades. And their pair trades were typically global in nature, not only domestic US, but global in nature, where they would be, for example, long on Asia and short on Europe and stuff like that. And these pairs delivered almost a 16% CAGR to the endowment fund, vis-a-vis at that point of time, during that time frame, the US markets were hardly delivering 2% per annum. However, over a period of time, as the markets developed and as global markets became more and more interlinked, at some stage the returns sort of disappeared, and therefore I think sometime around 2011, I think Harvard stopped using pairs as a technique through Morgan Stanley because they had a very large corpus. So what is essentially a pair trade? To put it very simply, those of you who know Hindi movies, you know that there's a movie called Naseeb, right? There are 2 brothers who are extremely close to each other. They leave together in the morning and they come back together in the afternoon or the evening. But then there's a famous song where both of these brothers, while they were together at the beginning of the sequence, become drunk and lose their closeness with each other for the duration that at least the song lasts. And while they leave, while they enter the bar together, while they become drunk, they sort of, start moving away from each other. But when they reach home, they are both together. So pairs is essentially the same thing. Markets are often drunk with volatility. Temporarily, even highly correlated sister or brother stocks, for whatever reason, tend to move away from each other. But like in this movie, if the pairs have the underlying nature that I'm going to talk about of coming back together, then there exists a major arbitrage opportunity. This is called spread arbitrage in mathematical language. If you can vouch for the relationship being very strong, when it is temporarily disturbed, that is the time at which you enter a pair trade. Meaning you know that both of these are sister or brother stocks, and therefore you have to take a position. Now, hypothetically, this relationship can be destroyed in a 1 hour window, in a 15-minute window, in a 1 month window, or in a 1 year window. So you've got pair traders of all kinds. You've got pair traders who trade minute to minute, and you've got pair traders who trade from a 1 year perspective. So, it depends on your skill set, your technology, and what kind of risk return profile you're looking at. But essentially, what pairs is nothing but going long on one security and going short on another security. Um, and essentially, therefore, you're creating a set of brothers or sisters as a position in the market. Now, remember, when you're creating a pair, you're always taking a position on 2 instruments in stock markets. Now, for example, if you were to do this in the stock markets, your position would be, for example, long ACC and short Ambuja, which is a trade which we are currently open in at Prabhudas Leeladhar also. Uh, by nature, pair trades in certain markets, everything we do is a pair trade. So, for example, when you trade spread contracts in commodity markets internationally, even in India, it was allowed some time ago in equities, or if you are in the currency markets, every time you are long USD INR, you are essentially short the other currency. and vice versa, right? So currencies by nature are paired trades, where every time you take a long position, you're by default taking a short position on the other instrument. And why do you do that? Because essentially you are betting on what is called relative momentum, meaning that you believe that irrespective of market conditions, the thing that you're long on or the instrument that you're long on will outperform the instrument that you're short on. That's basically why you're entering a pair trade. Now it's very much like children's school promotions. When certain children get promoted to a particular class, essentially the other students are you're short on other students. So I mean essentially you're always taking a decision consciously or subconsciously on a pair trade without realizing it. When your friend calls you and says go along on ITC because it's going to outperform the FMCG sector, essentially he's telling you in market language that he believes that you should be long ITC and short FMCG, right? So how the mathematical bit about mathematical slash technical bit about pairs. There are three very simple to use things once you get used. Although the words sound very dangerous, but essentially there are only three things that matter in constructing of a pair trade. One, there is something called correlation. So correlation essentially means that you want to establish that the two stocks you want to go long or short on are correlated. By correlation, I mean that their daily moves over at least the last 1 year, at least 80-85% of the time are in the same direction. So just to give you an example, you could download an Excel sheet of price for both these stocks, calculate the daily returns at the end of the day, and then see whether 80% of the time stock A was positive, stock B was also positive, and stock A was negative, stock B was also negative. If they exhibit this behavior at least 80 to 85% of the time in the last 1 year, you can safely assume that the pair of stocks that you selected are correlated to each other, meaning they will always move in the same direction. The other bit is co-integration. Now, co-integration is a very technical term, but it essentially adds value to creating the trade. So once you've found that two stocks move in the same direction 85% of the time, the second question is the relationship drifting? Meaning, while let's say Tata Steel and JSW Steel 85% of the time move in the same direction, however, is there a drift? By drift, I mean, is there a change in the relationship? Because let's say every single day when Tata Steel moves up 6%, JSW Steel moves up 8%. Okay, let me repeat. Just try and visualize what I'm saying. Tata Steel 85% of the time moves up 6%, JSW Steel moves up 8%. Tata Steel 15% of the time does not have any relationship. Tata Steel 85% of the time, when it moves down by 2%, JSW Steel moves down only by 1%. So when both stocks are moving up, JSW Steel is outperforming, and when both stocks are falling, JSW Steel falls less, which means it is still outperforming. So when you see this chart over a 1 year period and divide the price of Tata Steel, let's say, by JSW Steel, you'll realize that JSW Steel is becoming stronger and stronger and stronger, and therefore the relationship between the two is actually deteriorating, right? So while correlation says 85% of the time they move together, what you don't see is that the relationship is in one direction. Markets are saying JSW Steel is a stronger stock. It falls less, rises more. So how do you capture that? Now you can do two things. One is you can do if you're a very experienced kind of person, or if you're good at charts, etc. You could look at the chart over a 1 year, 2 year window and see if the relationship between the two is stable. Meaning, if you drew the average of the prices, you will not see any drift. Meaning the line of the price chart is essentially flat. Okay, let me do something. Let me take up this concept 2 minutes later because it will help you probably visualize co-integration better. The third is the Z-score. The Z-score is nothing but the trigger. It's the bullet that is fired. You need a benchmark, right? You need a benchmark when to enter and when to exit a particular trade. Z-score serves as that trigger. So if you have learned essentially, and there's enough and more material available on these three concepts, my advice is that don't worry so much about co-integration, initially at least. While I will show you what it means, don't worry about it too much. But you have to look at correlation and z-score because those are critical. And of course, the final thing that you should have some bit of fundamental analysis available. It could be via research reports, or it could be via visiting the investing.com website and just seeing how many people have targets on ACC and Ambuja, and broadly upsides and downsides are very similar in both of these. So if it's a fundamentally also safer ground, then it means that if you've entered a trade, you're not doing a fundamental mistake. It should not be that, for example, ACC and Ambuja have suddenly become very different kinds of companies because new technology was introduced or new managements were introduced, or the markets are completely different and the cement grades have changed dramatically. In that case, the relationship may be slightly dangerous in the future. They may not be brothers anymore. So it is important to randomly catch up on fundamental tidbits about the two stocks. Now, the first assumption we are making is that in a pair trade is that the relationship is cyclical. If both of them are brothers, there will be times when A will outperform B and there will be times when B will outperform A. So let me give you an example of, let's say, ACC Ambuja. This chart is a chart over the last 2 years. And now I'll tell you what I stopped earlier because I had not probably explained it to you. When you are creating a pair trade, let's say between ACC and Ambuja, let's say your trade is long ACC and short Ambuja. Now, if you're long ACC and short Ambuja, on a chart, how you will see it is that you will divide the price of ACC by the price of Ambuja. The numerator is the stock you are long on, and the denominator is the stock you are short on. So, for example, let's say ACC's price is 1000 and Ambuja's price is, let's say, 200 for simplicity. Then the price ratio is nothing but 1000 rupees ACC divided by 200 rupees Ambuja. So you get a price ratio of 5. Now, this price ratio of 5, if you want to remain long on ACC, means that you want this 5 to move up, not move down. Because if 5 is moving up, it means ACC is doing better than Ambuja, right? Now, I've drawn a chart of ACC's relationship with Ambuja Cement. They both essentially belong to the same parent group, right? And therefore, we can assume that there has to be a relationship. And that relationship is actually brought about very clearly over the last 2 years. So this chart, if you see, you will see that there are times, and this is a chart of ACC's price divided by Ambuja's price. You will see that the green lines represent when ACC started outperforming Ambuja. Then they hit a boundary. This boundary is nothing but a Bollinger Band. While I cannot cover Bollinger Bands right now, Bollinger Bands are boundaries, right? They are essentially a mathematical construct on a technical chart which shows you how much the price or how much the ratio has expanded. And when it's like a rubber band. The price can only move so much before the rubber band snaps back. So Bollinger Bands are a good way to measure volatility and direction of price movements. Now, if you see that the green lines mean that ACC was outperforming Ambuja, and then suddenly there were long periods of 10 days and 15 days and even 3 months, and in fact in the current run almost 3 months when ACC has been underperforming Ambuja. So the price ratio has been dropping, as you can see on the right side, right? Now, at some stage or the other, you would expect that if these two are brother stocks, ACC's decline versus Ambuja would be arrested. And sooner or later, this falling line that you see towards the end will start rising again, right? That is the essential assumption you are making in this price chart. Now, if you trade a pair, you're looking at two extremely high brother stocks. You can also at times look at paired, I would not call them pairs because there's no correlation. But for example, suppose you wanted to test the strength of markets. You could also see Nifty's chart, for example, versus Bank Nifty, the chart that I presented on the left. And if you started thinking like a pair trader, you will get some enormous advantage. I'll give you an example. This is the chart from January of 2020. when actually the Nifty started collapsing, and February onwards the collapse increased, right? Now, when a collapse of the market increases, the first sector which is very, very heavily weighted on the Nifty is the banking sector, right? So what happened was that the Nifty's price ratio started increasing versus Bank Nifty. So let's say Nifty was at 12,000, and just as an example, let's say the Bank Nifty was at 6,000. So the price ratio was 2. But as the markets started weakening, what happened was that the Bank Nifty started underperforming. So which means the ratio started increasing. So if you see on the left side, during the initial days, till about March, April, when the COVID news, etc. came out, Nifty was outperforming the Bank Nifty. And then suddenly you saw a time when suddenly the Nifty started underperforming. This was the time when market started stabilizing, right? You had the 7,500 kind of level on the Nifty start getting defended, and you started moving towards 9,000. Now you see this movement in June or July of last year, the Nifty and the Bank Nifty relationship was cyclical. So if you see, while both of them were falling, the fact is that if you see it in relative terms, it was like a blood pressure chart where you had up and down movements. It was not linear movement downwards or linear movement upwards as it was happening in the actual charts of Nifty or Bank Nifty. If you see, the Bank Nifty started suddenly outperforming, and it was at that point of time when the Bank Nifty starts outperforming, you realize that Nifty will sooner or later get strength. And then actually the Nifty started moving up. So from 9,000 odd levels, till very recently, when we reached, almost 15,500, it was a one-way rally because Nifty underperformed constantly all of this time period till recently. All right. And if you were a pair trader about 2-3 weeks ago, you would have taken maybe a short-term position because this does not justify a long-term position. You would have again gone long on Nifty and gone short on Bank Nifty. If you had done this trade about, I think, 3 weeks ago, you would be up by about 2 lakh rupees by now. So the one thing that you have to realize when you see this chart visually is that if you stop looking at Nifty or Bank Nifty in isolation and start looking at them as pairs, you'll realize that there's an up and down movement, and this up and down movement is essentially what we are trying to capture. Whether it is individual stocks like ACC and Ambuja, whether it is the Nifty indices. However, if you are a pair trader, the difference between the Nifty Bank Nifty chart and ACC Ambuja is that you will never do the Nifty Bank Nifty trade because correlation will not be more than 85%. There are days and days when Nifty does very well, but banks do very badly. But ACC and Ambuja will have a strong brotherly relationship. And therefore, you can actually execute this chart. There's a question from Soumya Ranjan, where to get these charts for paired ratios. I will, in about 15-20 minutes from now, I'll show you where you can go for free charts. So these charts that you see are on a website called tradingview.com. So you can use this site for free, except that there's a limitation on indicators you can use. But all the charts that I'm showing you, I have deliberately taken only from tradingview.com. So you can go to in.tradingview.com and construct a chart, just like I've constructed. For example, you could put ACC divided by Ambuja and you'll get this chart. Now, so once you've understood that correlation is important and that markets are cyclical. When I mean markets are cyclical, let me give you an example. ACC has moved from almost 1100 levels in the last 2 years to 2000 levels. Ambuja has moved from almost 180, 170 levels to 320 levels, right? These are very sharp one-way movements. But can you see any one-way movement in this chart? This 2-year chart shows it to be a very linear movement. Sometimes this is up and sometimes that is up, right? It is not a scary chart. It's a very flat chart, almost like a blood pressure, line. You'll be surprised if I told you that it is not just now. If you went back in history and saw these two prices way back in 2011, when ACC used to be about 800 rupees, I think, and Ambuja used to be 140, if the ratio of ACC to Ambuja right now is 7 times, roughly on an average, even in 2011, the ratio used to be 7 times. So imagine Ambuja has doubled, ACC has more than doubled in these last 9 years, yet the price ratio will always look like this, like a flat kind of line. And that is essentially the magic of pairs trading. So if two stocks are always going to move in tandem, sometimes one outperforming, sometimes the other outperforming, correlation is very high, then there is something called a cycle that you can benefit from. Now, how do you draw correlation? While correlation is very easy, anybody can take an Excel sheet, like I said, calculate the daily price returns and see if the prices. So there's a formula in Excel itself where you can, once you calculated daily returns, you can put a formula CORREL brackets and select the range, and you will get a correlation coefficient. So when it says 0.85, it means it's an 85% correlation. Now, when you're doing pairs trading and you want to do them safely, you will essentially do pairs trades which are positively correlated. Meaning, when one is up, the other is up. When one is down, the other is down. That's called positive correlation, right? You don't want to obviously do stocks like Nifty and Bank Nifty because those are not pair trades. Those are index-based trades, long-short trades, what are called. You don't want to do things which are not correlated. So, for example, you can't be long Reliance and short Ambuja, right? Unless you have your own strategy, because those are not correlated. They are not the same sector also. And obviously, you cannot do negative correlation because these are dangerous trades where you are taking, because the positions could move 30% on the long side against you and 30% on the short side against you. So you don't want to do such crazy trades. Especially if you're a novice or if you've just spent a couple of years doing, always positive correlation stocks are what you should look at. Just take a simple Excel sheet, take the data from Yahoo, Google or NSE, calculate the daily returns. My suggestion, lots of pair traders use only 50-day and 100-day. Don't do that. Use at least a 1-year window because that captures all the movements over the last 1 year, and then see if your coefficient of correlation comes to more than 0.85. If you don't know how to calculate the correlation, Shilpa's WhatsApp group, you can put a message and it will forward you an Excel sheet that shows you how to calculate this correlation. I'll not go into the slide because I think you will get confused. Let me actually show you the actual charts rather than this slide. Okay. When we talked about co-integration, I essentially said that two stocks may be correlated, but the relationship may be drifting. So I'll give you an example. Let's say, for example, you're looking at this chart, right? Now, this chart, remember, is not a flat line. There is a definite trend upwards. This is called a drift in our language. It's called a drift, right? Even if there's a drift, it's okay to trade. I'll give you an example. HDFC Bank has a very, very strong drift. HDFC Bank to Bank Nifty chart will look exactly like this. Whether you look at the last 6 months, 1 year, 2 years, 5 years, 10 years. Because on an average, HDFC Bank always has traded an ever increasing premium to the Bank Nifty. While the Bank Nifty has suffered from, PSU issues and Axis Bank and ICICI Bank and so on and so forth. So except Kotak Bank, HDFC Bank is the only other bank which shows you a chart which broadly looks like this. This does not mean that you cannot do a trade. First, you have to see whether the stocks are correlated. So which means, does HDFC Bank go up in the same direction as the Bank Nifty at least 85% of the time? If the answer is yes, then you move to step number 2. Step number 2, if you have a mathematics degree, you can do what is called a co-integration calculation. If you don't have a mathematics degree, don't give a damn. All right? Actually, don't care about it. What you should do is, you have to be aware visually. So which means you deploy a chart and see that when you have drawn the price ratio of the two instruments, is that chart showing you an upward or a downward drift? Ideally, if the stocks are perfectly correlated, then this arrow will not be upward or downward, it will be flat. That's like the craziest pair trade. That's the easiest pair trade which even a 2-year child can execute. But life is not like that, right? You will get a certain drift because stock A or stock B may have been constantly weakening against the other one. So drifts are something you have to deal with every day. However, this does not mean that you don't do the trade. This only means that either you calculate co-integration and then you come to know that yes, the stocks are co-integrated, meaning that the mean is constant, which means even if the mean is increasing or even if the mean is decreasing, the fact is that there is cyclical behavior around it, right? So you can do a visual inspection on a chart and see whether the mean is more or less stable. So to give you a practical example, let me take you to this chart. Now, okay, unfortunately, I've taken a 2-year chart, but suppose you took an 11-year chart on ACC and Ambuja. Can you see that while obviously there are periods of drift of upward and downward movements, if you looked at very long time periods, or if you looked at the average of this average, you will see that the line is more or less stable. You don't need to be scared because these lines are very smooth. It means that whichever direction there is, first of all, you can see visually that this is alternating, right? Strength, weakness, strength. And now if you get strength here, you'll be 100% convinced that this is a continuing behavior of the past. So if you were to draw an average of the averages, is that more or less a straight line? Now, if you do it for ACC Ambuja, you will realize it's almost a straight line. So either you can do all this mathematics, or what you can do is that after visually inspecting it, you keep a stop loss on your trade and bet that the mean is actually stable. You could do either of the two things. Again, if you want reading material on co-integration, or if you want to understand how to calculate average of averages, you can put a message on the WhatsApp group. But it's actually very simple. It's nothing but taking the average of the price ratio like I did in the previous chart, and then calculating a moving average of that over a 50-day period, right? And if this line is more or less straight, it means that the pair is co-integrated. This is simple math. You want to do complicated math, you are welcome. Or you want to do visual inspection, also you're welcome. So till now, what have we done? We took two stocks from the same sector. After we took two stocks from the same sector, we calculated correlations to find out whether, so for example, in the cement sector, you'll get Shree Cement and you'll get Lakshmi Cement and you'll get ACC and you'll get Ultratech. You might have even put in Grasim earlier and so on and so forth. So there are some 10-20 stocks available. Now, out of these 10-20 cement stocks, you have to find the two stocks that show the highest correlation, right? Which you've done on an Excel sheet. So after you shortlisted a list of stocks, then you drew correlation within the same sector. Then once you've selected these two stocks or 2-3 combinations of two stocks, then you did co-integration, which means that the relationship is stable over a period of time is what you were trying to find out. So you did selection of a sector, then you did 2 stocks or 4 stocks or 6 stocks correlation versus each other, and then you finalized 2 stocks which exhibited a more or less nice co-integration, or what I said, a straight flat line on a chart. So far, you've now got everything you need. What don't you have? You don't have something called the trigger for the trade. Fine, you've done all the math. Now markets have started. It's 9:15. Now what do I do? How do I enter the trade? So to enter the trade, it's fairly simple. If you are new to technicals, then you need to definitely read a little bit on something called Bollinger Bands, because that is at the core of what is called the Z-score. If you don't want to read up, but you know how to, go to tradingview.com and select indicators, then you could do that also. But I'll quickly give you a 30-second brief. The Bollinger Band is essentially capturing the rubber band effect, how much prices move up and down. If you see in many of the previous charts, I had drawn boundaries, right? These boundaries are called Bollinger Bands. So these charts are 200-day Bollinger Bands. And when you go to TradingView or any portal, it will ask you two things. What length of the Bollinger Band do you want to use for your analysis? And what is the standard deviation values? Meaning, when should I draw this line? If the line is 2 standard deviations away from the average, or 3 standard deviations, or 1 standard deviation. So in mathematics, and if you've forgotten all this, go to Google or ask your children, and they will remind you what it means. It is assumed in mathematics that 2 standard deviations in nature, whether it is studying about weather patterns, whether it is studying about heights, whether it is studying about anything in life, if you do a 2 standard deviation analysis, whatever sample you are doing, 95% of the values will fall within this. So in our language, to trade markets, when I draw a Bollinger Band with 2 standard deviation, it is essentially saying that the user can assume that 95% of the time, all the observations that you see will fall within these Bollinger Bands. So which means whenever some observation moves out of this Bollinger Band, it is abnormal behavior. And once it becomes abnormal behavior, there is a trade, right? So, for example, in life, if somebody is in a family, there are 8 children. If the first 2 children are born with a height of 7.5 feet, while historically in that family nobody had this height and the average height was, let's say, 6 feet, it means that these children at 7.5 feet are 1.5 feet away from the average of 6 feet. And if the family's history was fine, Bollinger Band will say that it is likely, therefore, that the next child which is born will be in or around, but definitely below 7.5 feet. Right? He's going to be a normal child. That is what Bollinger Bands try to project. Right? However, the problem with Bollinger Bands is that if you see here, the problem with Bollinger Bands is that if you select ACC Ambuja, you will get a different kind of Bollinger Band. If you, let's say, now you have only 1 lakh rupees available and you have 2 trades available, one ACC Ambuja and one, let's say, I don't know, maybe, I don't know, Hindalco and Tata Steel, for example, and you have to select one of these 2 trades, then you can't select because both of them may have similar configuration of this Bollinger Band. So how do you select? So there's something called Z score, which basically brings all the Bollinger Bands into one common mathematical number, so that when you have multiple trades to choose from, this number will tell you which of these trades is the best trade to select. Now, I don't want to get into the mathematics because the mathematics is a very different thing. But if you went to tradingview.com, put these charts, and then in the indicator set, if you see here, there is something called indicators, right? From here, you select what is called Z-score, right? Now, I have done this Z-score analysis for 50 days, okay? Meaning, I have selected Bollinger Bands for 50 days and a standard deviation of 2. And then I put these 2 lines. I'm saying that whenever Z score goes beyond 2 and then starts coming back inside this 2, give me a indicator, right? This could happen from -2 and moving up, or it could happen from +2 and moving down. These are the boundaries. So whenever a boundary is hit by a pair, let me know, because that means I have to watch this trade. Now, how do you do this trade? Why did you first of all select this trade? Because 2 things. You decided that the 2 stocks are correlated. Then you decided that these stocks are co-integrated, meaning that this relationship I don't expect will change. This relationship will continue to remain cyclical like this. So then you said, I'm very happy with this trade. Whenever this trade gives me a signal, please let me know so I can enter this trade. So I'll give you an example. How do you enter the trade? So if you can see here, where I had drawn the Bollinger Band, ACC divided by Ambuja. So you can see here, ACC's price divided by Ambuja started moving in one direction. Then it hit the boundary. Once it hit the boundary, it became an extreme event, meaning, like that children example I gave, this behavior of staying outside this boundary is not likely to last. So, but you cannot enter a trade just because this has happened, right? Because you need something called confirmation. Correct? You cannot enter the trade because it has gone in one, because it's possible that ACC may have permanently changed and the trade goes like this against you, right? In a one line. So what do you want to wait for? The minute this boundary has been hit, Z score of 2 was crossed. The Z score of 2, the minute it is crossed, this trade should be on your watch list. Now, the minute a re-entry happens, so for example, in this case, it's a very simple case. Normally, it's not so easy. I mean, here also it's very easy. Here also it's very easy. In fact, this is my favorite trade because it's very easy most of the time. The minute it hit 2, next day onwards, it re-entered the normal situation. Normal meaning it re-entered below a Z score of 2. The minute you see a re-entry below the Z score of 2, now if you've taken a daily chart, then you want for a daily close. If you're taking a 1 hourly chart, then this could be a 1 hourly close. I mean, it depends on your skill and technology. I only use daily charts because I cannot trade very often. So if you're not a very frequent trader, I would prefer daily charts. The minute it crossed 2, the trade came on your watch list. The minute it re-entered normalcy, Z-score fell again below this boundary of 2, which means you would have entered this trade on the next day, and this move you would have participated in. Now, what is the rule of a pair trade? When you've entered on this rule, always exit around the mean, meaning you expected normalcy. I will again repeat that same example of the child. Everybody in the family was 6 feet. One child was born 7.5 feet. This one child is one out of 20 people in that family of 6 feet. Therefore, as per the nature of the law of averages, this is an exception. The next child will definitely be somewhere around the mean, right? So when you've taken the position on a pair trade, you expect it to go to the mean. And what is the mean? The mean is the average, this moving line, right? So the minute the pair reverts to the mean, that is the time for you to exit, because then you don't know what is going to happen, whether it's going to move up or move down, right? So this is a good exit signal for you. This is a good entry signal for you. However, since this entry signal varies from pair to pair, what you do is make all the pairs common by using Z-score rather than actual Bollinger score, right? So this Z-score is a very, very easy blood pressure kind of map to tell you when abnormal behavior happens and for you to start expecting normalcy from then on, right? So if you set up Z-score on your charts, if you've done correlation on your Excel sheet, once in every, maybe 1 month is okay. You don't need to, I mean, maximum 1 hour on a Saturday or Sunday, maybe you could do this. Or you could use any of the tools. So for example, there's a website called myfno.com. You could also subscribe, where all of this is ready-made. You don't need to apply your brains beyond the point, right? So it depends on how you wish to do these trades, but all of this is readily available, whether free or paid. So you've done correlation, you've done co-integration or visual inspection, and now you've put up a Z-score, right? Now let's say I get a trade. I've got this situation where the Z-score went below 2 and made a re-entry. So I would expect that this Z-score would start recovering from -2 upwards. So let's say I want to enter this trade. So how would the trade look? So the trade would look something like this, where if you see this chart, this was ACC divided by Ambuja. So if you expect -2 to start moving upwards, it means you want to be long ACC and short Ambuja cements, right? So how would you do that? You would buy one lot of ACC, March or April futures, depending on whether you think that the Z-score will, recover this month, or it'll recover next month, or it'll take slightly longer. Depending on your analysis, you could enter long ACC and short Ambuja. Now, your target ratio, when we say target ratio, what we mean is that, for example, suppose I got the signal here, right? The pair ratio then was about 6.2. I expect this pair to move towards the mean. So which means here, the pair at that point of time, the pair ratio is 6.35. The mean is 6.35. So the trade basically would say long ACC, short Ambuja, target ratio of 6.42, which is the mean. This is an example, so it does not correlate to that chart, but this is the mean value. Stop loss ratio of 6.2. How do we determine the stop loss ratio? While you can actually, what you can do is you can put a hard stop loss of about, see, these days, each trade that you do in futures is about 10 lakhs, right? Now imagine you're doing one long and one short. So you're taking a 20 lakh position. On this 20 lakh position, you can do two things. One, you can do mathematically, or you can just take a 2% stop loss. So meaning typically our trades that you see from Prabhudas Leather, you will see that the stop loss is between 35 and 45,000 rupees because of the lot size. So on an average, 40,000 rupees per lot is the stop loss you can put, which is nothing but 2% of the gross value of the position you've taken, right? Or the other way to do it, slightly complicated, is that if you read the if you understood that example of the child, it's called normalcy curves, right? Normal curves. So when you take the value of 2 on Bollinger Bands, this is normalcy. Anything outside is extraordinary. But and by extraordinary, meaning that the value will stay mathematically in this range only 5% of the time, right? But what if the relationship has been destroyed and you did not know it? There was some news that the Ambuja management is going to resign. You didn't know that. You, based on some movement of the chart, suddenly entered the stock. You are not aware of what is happening, right? So at some stage, you have to put a stop loss. So what we do is that in mathematical terms, you select a 3 standard deviation, which is another Bollinger Band, which I'm not showing here, but there's another Bollinger Band you can construct, which will be a 3 standard deviation. So once the pair ratio crosses 3 standard deviation, you should exit the trade. Okay, that's essentially what we are saying. So either you do this calculation of the third standard deviation Bollinger Band, or you, in my experience, you can actually put a stop loss of 35 to 40,000 or 2% of the gross value. 95% of the time, this value should not even happen. But that is your extreme stop loss. Okay. And when we give you a pair trade, we will typically mention the correlation. So for example, in this, if the value is less than 80%, don't even bother doing the trade. If it's about 90%, do it quickly because it's likely that you don't have many days before the trade actually becomes profitable. Now, so if you are a subscriber of my F&O, then you will know this. If you are not, don't bother because you can do the same thing yourself, like I showed you using tradingview.com. What will happen is that when the Z score recovers from -2, for example, in this case, it becomes a signal for you, right? Now, all of these boundaries are signals. See, boundary exceeded, boundary re-entered. Boundary exceeded, boundary re-entered. Boundary exceeded, multiple trades. Over the last 3 months, this is HDFC to HDFC Bank. Over the last 3 months, multiple signals have come and failed. Right? Now, that is happening because there's some bit of drift in this trade. You will not be able to understand this right now. My only suggestion is starting initially, some trades are very volatile trades. By very volatile, I mean, even if markets strengthen and you get a signal on long HDFC and short HDFC Bank, be slightly more conservative because HDFC Bank will recover first for many days before HDFC starts recovering, which is what causes these multiple signals. But this is almost a 1.5 month old chart. If you see now, you will see that this has actually done a very good recovery. This trade actually did a very good recovery, right? So some bit of experience and you'll start learning the trick of the trade. Or you can follow the Prabhudas Leeladhar recommendations initially because we try to be extremely safe with the trades we are giving. So you've set up your correlation, you've set up your co-integration, you've set up your technical tools, and now you've set up an umpire at the boundary who is telling you whenever Z-score exceeds and re-enters, that's the time. So what else do you require? So like I said, apart from correlation, the other thing that we are doing is not entering into F&O stocks beyond the top 100. Ideally, even within, if you stay in and around Nifty, I think you'll have a fair degree of safety because Nifty has a lot of basket investing by FIIs, right? So if there are sudden moves in the market, typically you will see all of the stocks moving in the same direction in the Nifty, and therefore try and restrict your initial trades to stocks within the Nifty till you become familiar, and then you can take the bigger, gambles. Try and do a little bit of fundamental analysis to ensure that the stocks are not very differently valued. I mean, somebody should not come out and say that, the cement that Ambuja uses, is extremely different from the cement grades that ACC produces, and the government may soon ban, one of the two varieties. That means that the pair is dead, right? You don't need a chart to show you that. Then stay away from that trade. Also, stay away from the trade if there are any important announcements in the stocks in the next 1 to 2 weeks window. We normally don't bother too much. If the correlation is very high, then you will see, because if you see one of our trades, ACC Ambuja, virtually we do this trade very, very regularly, and normally we are very successful very fast. This time we are slightly stuck in it, but we expect to get out of it soon. We have lived through all results of all the ACC results and all the Ambuja results, and actually still exited profitably in almost every trade. I remember about 2-3 months ago, Ambuja came out with a result which caused its price movement upwards by about 8%, and the opening gap was very high, but we don't take stop losses on opening gaps. But ACC had also, by the way, started up 5%, right? Even though ACC had no news. It's because they were correlated, right? The minute Ambuja came out with positive results, ACC also started with positive results. So there was a net loss of 3%, in the next 2 days, that loss was covered by ACC. By that time, people started selling Ambuja because they had made money. So suddenly the trade started moving in our direction. So for a lot of reasons, pair trading is very exciting because it essentially means go long the underdog and go long everybody's favorite stock, right? So you're buying something which is cheaper than it should be, and you're selling something which is more expensive than it should be, except that you're using a different formula for doing all that. So in that sense, it's a very, very commonsensical trade. So just to clarify two things, because I've not mentioned them, why will you make money? So let's say, I mean, the doubt that may be there in your mind is, suppose I've gone long ACC and suppose I've gone short Ambuja and I've done all the analysis. Tomorrow Nifty opens down 20%. What happens? So, I mean, the idea behind long short is that the only thing you have to be right about is two things. One, do you think ACC and Ambuja are brother stocks or sister stocks? And two, is their market size more or less equal? I'll come to market size 1 minute later. When I say, let's say the market opens down 20%, I don't care if ACC, where I'm long, also opens down. I don't care if Ambuja also opens down. The only thing I want over the next 30 days, and plus I'm not bothered only about tomorrow. The only thing I'm bothered about is, if tomorrow everything is down, ACC should be less down than Ambuja. Suppose I lose 3% on my long and lose 5% on my short, I mean gain 5% on my short, I am still up by 2%, right? On the lot. If the markets opened on an up circuit tomorrow, I don't care what happens to individual prices. All I want is ACC's price should be more up than Ambuja. For example, ACC rises by 5%, I make money. Ambuja rises by 3%, I lose money, but I still make my 2%. So what do you want? You don't care about actual price movements. You only care about outperformance of your long over the short. And which is why markets are removed out of the equation, because you don't care what happens to Nifty. You don't care what happens to the cement sector. The only thing you care about is whether you got your outperformance theory right. Right? After that, there is no, I mean, you don't have to worry about what announcements are coming. You can keep your TV switched off for the next 6 months also. Right? The second thing is that it should not be, I'll use the same example. Let's say you went long on ACC, which is an 8 lakh rupee lot, and you went short on Ambuja, which is a 10 lakh rupee lot, right? Now you make 5% on ACC, but then the lot size was 8. So which means you actually did not make 5%, you effectively made only 4%. And let's say Ambuja rose 4%, correct? If Ambuja rises 4% on 10 lakh rupees and you rose 5% on 8 lakh rupees, your net return is 0. So even though ACC on the chart showed that it outperformed Ambuja by 2% today, you did not make any money because the ACC lot size was smaller. This is called market neutrality. So which means if you want to remove the market out of the equation, what should you have done? You should have bought one lot of ACC for 8 lakhs. You should have sold one lot of Ambuja for 10 lakhs. But because you are long by 2 lakh rupees less, you should have bought ACC in the cash market also. So your total exposure in ACC is 10 lakhs and your total exposure on Ambuja is 10 lakhs. Now you are truly market neutral and you should not care about market movements. This is extremely important. So once you have done your selection of trades, once you've done your co-integration, once you've selected your Z-score, and once you've made your trade market neutral, you're ready for the trade. All you need to do is only keep a list of your favorite stocks on the Odin terminal, which, for example, in my case, often is only 8 or 9 stocks that I watch from a pair point of view, just out of curiosity on what's happening to relationships. You don't need anything more than that. Now, the risks involved can be fairly high. I think, like I said, there could be news and announcements. You have to be extremely careful. You have to be very, very careful about market neutrality of the trade. See, it won't really matter if one is 9.5 lakh, because sometimes you need to be long on a stock which is higher in value. Then you can't do short in the cash market, right? I mean, you can do SLB, but why would you bother to do all that? So if the difference between the two is not very, very high, right? If it's, let's say, 10,000 rupees pay, it is about 50,000 rupees difference, then you don't care a lot, because over a period of time, especially if the correlation is very high and the gap is very long, you will still make a decent amount of money, right? So be as careful about market neutrality, but do watch announcements and corporate results, etc. Try and stay away initially. You will get full experience. My suggestion is, when you are evaluating these charts or evaluating these trades, try and look for correlation only about 85%, and try and look at stocks which are moving almost similarly over the last 2 3 years. I mean, for example, if it was banks, I would always trade HDFC Bank only against Kotak Bank, because Kotak is the only bank which can match HDFC Bank in its momentum and its direction and its volatility. HDFC Bank is smoother, Kotak Bank is more volatile. So therefore, you have to be slightly more cautious about re-entry. So when you get an alert, don't be in a rush. Wait for 1 or 2 days, because when the movement starts, it will move in your direction. Give it some extra time so that it turns out to be a safe trade. Don't jump in immediately. So the lower the correlation, take more time to enter the trade. The higher the correlation, enter the trade as fast as you can. Basically, that's a simple equation. You can read a lot. There are n number of books available on pairs trading. My out of these, my favorites would be the book by Ganapati Subramaniam, because that uses very easy language. I think, and it's fairly well available on Telegram and internet. Try and use that, read that if you can. We've also written a lot of articles on our blog site, plindia.blog, plindia.com/blog. You could refer to that. You could also park queries with us on the WhatsApp group that Shilpa is going to create. But this is something I would encourage all of you to actually start looking at, not only from trading pairs point of view, but relative momentum as a concept is actually going to help you, even if you take market views. The first chart that I showed you on Nifty Bank Nifty, for example, every time Nifty outperforms the Bank Nifty, you know that sooner or later the Bank Nifty is going to recover its outperformance. When it does, you can expect a very sharp movement in the Nifty itself. So, you'll get a hang of market movements if you start looking at relative charts. With these closing comments, I thank you again for having participated. I will try and answer any questions which are there in the chat box now. Yes, Soumya, absolutely right. I didn't mention risky trades, BPCL, HPCL, RAC, PFC. There are, so I mean, you are absolutely right. So when somebody recommends BPCL, which has already run up sharply on the announcements of disinvestment and all, normally you are right. So what I do is, for example, in my case, I would look at the pair chart and start seeing whether HPCL begins to outperform. So what I do is, instead of buying BPCL, I actually end up buying HPCL, right? Because I expect HPCL to start outperforming BPCL. Won't the lot size matter too? Got it. Yes, absolutely. And I answered it. Does any side give the high correlation pair stocks? No, unfortunately. My F&O gives you correlations. So if you want to subscribe to my F&O, correlations are available there. But otherwise, there are very few sites on this topic available right now. There are no other questions. I'll wait for another 30 seconds. Just to repeat, Shilpa will create a WhatsApp group and you can always park your queries there and we'll answer those.
Yes, sir.
Does any site give the high correlation? Can you recommend 20 such pairs? Yes. Samya, we'll put a list of, I don't know, 20, but 10 safe pairs I'll definitely put, because see, theoretically, you can trade anything against anything, right? But we don't want to take risks on safety. So when you are starting out, like I said, we will try and give you a list of 8 to 10 very relatively safe pairs, yes, in the WhatsApp group. If there are any other questions, you are free to please put them in the chat box. I'll hold for another 30 seconds or in the Q&A section. Can you give some good past trades? Yes. Shilpa, can you forward our trading pair sheet in the
Yes,
WhatsApp
sir.
group?
So I have Somya's number also. He has been always in all our webinars. I'll share
Lovely.
him.
Of course. Okay. Soumya will do this. So in the last 1 year, Soumya, just to give you an example, what we did was, broadly remove all very high volatility trades, because even if you time your trade well, and the lot size is, let's say, 12 lakh rupees, even if you make a mistake only by 2%, it's a 40,000 rupee loss. So what we did was reduced all the high volatility trades in the last 1 year, focused on delayed entry, and then suddenly started getting a 95% hit rate, right? So when we send you the sheet, do look at these trades. There are many trades which we've never given, which also we will try and sort of share on the WhatsApp group. I think ACC Ambuja is very good for the April series. Yes, Shilpa.
Yes, sir. Yeah,
Mrs. Shivraj,
Shivraj
yes,
will,
we'll
yes,
do
we'll
this.
share.
All right. Thank you so much for participating in this session, and look forward to seeing you again. Thank you so much.